everybody. Tom Berry here with ILS Capital, and the topic today is, what is an evergreen or open fund? We get that question a lot. Is your fund open, or is your fund evergreen? And the answer is, well, it depends. We have two funds that are open or evergreen, and we have others that are not. So let's talk about the ILS Growth Fund and the ILS Income Fund first. Those two are evergreen or open. Now, what does that even mean? What it simply means is that we can raise capital in either of those funds into perpetuity. There is no end to when we can raise capital. The only thing we are limited by is the amount of capital that we raise. So we send notice to the SEC of how large amount we want to raise in the fund, and once we get to that cap, we can't raise anymore. So at that point, we would have to close that fund to new investment. Now, new investment means simply new money coming in. It doesn't mean reinvestment of earnings for the folks that are already in that fund. That, of course, would take it above the limit, but that's perfectly legal and fine. But the other thing that we are limited by is the amount of deals that we can do that meet that fund's criteria. So for the growth fund, if we ran out of fix and flip loans or commercial repurpose loans or redevelopment loans, we would have to stop taking money in that fund. The income fund, if we ran out of income producing real estate loans, again, we would have to stop taking money into that fund. We've not experienced that yet, and we don't believe and don't foresee that happening anytime soon. So our real limit that we see is the limit by the SEC that says, hey, you can't grow a fund any bigger than this. And when we hit that limit, we'll have to stop that fund from new investment, and we'll have to start another one just like it right beside it with a new name. So that is what an evergreen or open fund is. Let's talk about a fund that isn't open, though, because we do have one of those at this point as well. The ILS Equity Fund Class A is not an evergreen fund. That is the fund that we use to purchase a shopping center in Dayton, Tennessee, and when we purchased that shopping center, we had a defined date that we needed to have all of our capital in. Well, what was that defined date? Well, by the closing, right? Anybody that wanted to invest in it, we needed that money in by closing. We actually fell a little bit short of closing. We covered it, and we continued to raise for a couple of weeks while people got their money moved around. We got it all done, but by and large, you're going to have a dead date, a deadline date of when you have to have the capital in when you're purchasing a physical asset. When we're purchasing notes, the money comes first, and then we shop for the notes. I described that on a previous video. But on physical assets, the asset identification comes first, then you shop for the capital. So in a non-open or non-evergreen fund, we have a defined date that we need to have the money in by so that we can close on that asset and start the process of whatever we're doing with it, whether it's just holding it for stable cash flow or whether it's repurposing or repositioning or value add. We can start that process after closing. So that's the difference between an evergreen or open fund and a non-evergreen or non-open fund, or closed fund as it might be called. And hopefully that is helpful for you. If you have any more questions about that, please feel free to email me, and if you'd like more information about any of our funds or our loan products, click the link below and we'll be happy to start that conversation.